why you are still not profitable. It's not your strategy, it's your psychology. Be honest. You've watched lots of videos. You've changed strategies. You've tried indicators, price action, smart money concepts, signals, bots, even intuition. And yet your account still bleeds. Here is the uncomfortable truth most traders never hear. It's not your strategy, it's you, your mind, your emotions, your decision under pressure. Because the market doesn't take money from bad strategies. It takes money from undisciplined behavior. And today, we are going to decode exactly why. Not with motivation, not with hype, but with psychology. The same forces that control fear, addiction, impulse, and self-sabotage are the same forces controlling your trades. Stay with me, because if one of these points hits you hard, it might change how you trade forever. Let's start with the silent killer. Number 1, fear, loss aversion, and panic selling. Picture this. You are in a clean trade. Your setup is valid. Your stop loss is placed. Price moves slightly against you. Your heart rate increases. Your breathing changes. You zoom into the chart. Then it happens. You close the trade early. Small loss. Relief. Minutes later, price reverses. Hits your take profit without you. And suddenly, the pain is worse than loss you avoided. This isn't bad trade. This is loss aversion. Your brain is wired to feel losses about twice as strong as gains. Psychologically, losing $100 hurts more than winning $100. Feels good. So your mind does something dangerous. It prioritizes emotional comfort over mathematical expectancy. You panic and sell. You cut winners short. You let losers run, hoping they will come back. Another scenario, you enter a crypto trade during volatility. A red candle prints fast, your brain screams. Get out now. You don't follow your plan, you follow fear. Later, you look at the chart calmly and say, why did I do that? Because in that moment, you weren't a trader. You were an emotional person trying to escape pain. The market exploits this relentlessly. Every stop hunt, every fake breakout, every violent week are designed to trigger fear. Actionable takeaway. Before you fix your strategy, you must learn emotional regulation. If you can't seek through normal drawdown, you don't have a trading problem. You have a nervous system problem. Now let's flip the emotion. Number 2, overconfidence and risk management. This one destroys account fast. You have a winning streak, 3 trades, 5 trades, maybe 10. Your confidence skyrockets. You start thinking, I have figured it out. So you increase lot size, you widen stops, you skip confirmations, and the market waits. One bad trade, then another. But now, you don't want to accept it. You double down, you revenge trade, you overtrade. This isn't confidence, it is cognitive bias. Overconfidence bias makes you overestimate your skill after short-term success. For example, a trader wins during a trending market week. Every setup works. He thinks he had cracked the code. Following week, the market ranges. Same strategy, same confidence. Losses pile up. Instead of adapting, he forces trades because his identity is now tied to being right. Crypto traders feel this even harder. A lucky outcome pump convinces someone they are a genius. They ignore risk, they chase leverage, they believe volatility equals opportunity until liquidation teaches humility. The market doesn't punish confidence, it punishes arrogance. Actionable takeaway: your edge isn't proven by wins. It's proven by how little you lose when you are wrong. Real confidence is boring, quiet, measured. If your confidence makes you reckless, it's not confidence, it's ego. Now let's talk about something subtle. Number 3, social proof and hard behavior. You open social media, someone posts profits, another posts withdrawals, another says Bitcoin to the moon. Suddenly, your plan feels weak. You weren't even looking for a trade, but now you feel behind, so you enter late, chase price, ignore structure. This is social comparison theory at work. Your brain assumes if everyone else is doing it, it must be right. But markets don't reward crowds, they exploit them. A Forex example: during major news, Twitter explodes. Everyone is bullish, no one direction. Retail piles in, price spikes, then violently reverses, stops are wiped, emotions are crushed. Crypto is even worse. Influencers, hype circles, fear of missing out. You buy tops not because your analysis says so, but because you didn't want to feel left out. Another scenario: you were patient all week, no good setup. Then you see others trading aggressively. You feel pressure. So you frustrate, not because the market invited you, but because your ego couldn't handle inactivity. Actionable takeaway: your job isn't to trade often, it's to trade well. Silence is a position. Patience is a strategy. If your decision change because of other traders, you are not trading the market, you are trading your emotions. Now let's talk about time. Number 4. Delayed gratification and the long-term mindsets. Most traders fail here. You want result now. You want consistency now. You want to quit your job now. But trading doesn't work like that. The psychology of delayed gratification separates professionals from gamblers. A trader takes a perfect setup, small position, small profit, it feels underwhelming. Another trader takes a risk setup, high leverage, high win once. Guess which behavior gets reinforced? The brain loves fast rewards, so you start chasing excitement instead of expectancy. Forex example: scalpers overtrade because waiting feels like pain. Swing traders exit early because waiting feels uncertain. Crypto traders hold losers too long because selling feels like admitting failure. The market rewards patience, but your brain hates waiting. Delayed gratification means doing the boring thing over and over without emotional payoff until time compounds your edge. Actionable takeaway: if you need excitement to trade, you are in the wrong business. The goal isn't dopamine, the goal is consistency. Now we go deeper. Number 5. Emotional independency and discipline. Discipline isn't motivation, it's independence from your emotion. A disciplined trader doesn't feel less emotion, they just don't obey it. You feel fear, you follow the plan. You feel greed, you follow the plan. You feel boredom, you follow the plan. A common scenario: you promise yourself only one trade today. First trade, losses. Your emotions scream, make it back. You break your rule. That's not lack of knowledge, that's emotional dependency. Your emotions are controlling your actions. Another example: you feel euphoric after wins. You trade more, you give it back. Discipline means acting the same on your best day and worst day. Actionable takeaway: create rules so simple your emotional brain can't negotiate with them. If rules are optional, they are useless. Now, something most traders ignore. Number 6. Metacognition. Learning from past mistakes. Most traders repeat mistakes because they never truly reflect. They journal entries, but not emotions. They track setups, but not decisions. Metacognition is thinking about how you think. A forex trader keeps losing during London Open. He blames strategy, but deeper analysis shows something else. He trades impulsively because volatility excites him. A crypto trader keeps holding losers. He says it's long-term belief, but journaling reveals fear of being wrong without awareness. You can't change behavior. Actionable takeaway: after every trade, ask, what was I feeling before, during, and after? Patterns will expose themselves. Now, let's expose the traps. Number 7. Cognitive biases that sabotage decisions. Confirmation bias makes you only see what supports your trade. Anchoring bias locks you to a price that no longer matters. Recency bias makes recent wins or losses feel more important than they are. Learned helplessness makes repeated losses convince you that nothing works. These biases aren't weaknesses, They are human, but unaddressed. They destroy traders. Actionable takeaway. Question your certainty. When you feel sure, that's when you should be most cautious. Finally, number 8, personality traits and trading style. Some people crave action, others crave control. Some are patient, others impulsive. If your trading style doesn't match your personality, you will self-sabotage. An impulsive person on swing trading daily chart will overtrade. A patient person scalping 1-minute chart will hesitate. There is no best style, only alignment. Actionable takeaway. Build your strategy around who you are, not who you wish you were.